Did you know that signing a personal guarantee, or affectionately sometimes called a PG, is not necessarily a prerequisite for funding? I didn't know that, and I come from a banking background. And there's plenty of other things that I've learned in this next video, so do stay tuned, where I speak to two finance experts in the world of securing finance for businesses. Enjoy it. Hi, and welcome back. My name is Rob Goddard. I'm a multiple business owner, and I'm delighted to welcome two guests today, Clive Pacey and Phillip Lewis. Hi there, chaps.
Hi there.
Good morning.
And we're going to talk about a subject that often people have lots of urban myths about. This is financing, business funding, business finance. And I've got two experts from the world of, nothing like setting you both up, two experts from the world of finance to perhaps dispel some myths and give some food for thought, actually, and a bit of guidance and help. Perhaps Clive, if you could start just a very brief introduction, who you are and the sort of things you get involved in day to day.
Thanks very much, Robert. I'm Clive Pacey. I'm an invoice finance broker primarily, but also deal with brokering of all types of business finance, right the way through loans, equipment finance, all asset finance. I've been active for about 11 years. Unusually, I'm not from a banking background. I'm from the management of treasury and accounting and credit management within industries such as music and advertising and all the glamorous ones like that. So it gives me a little bit more of a perspective, perhaps, from the business owner's point of view. My attitude to the work has always been to find the very best for the client. I don't represent any lender whatsoever. It's a very deep and complicated market. It's got more complicated over the years, and it's a very interesting way of working as well, getting to understand business owners, exactly what they're about and what their objectives are as well, and working with them very closely to find the best solution, because financing is vital to a business and you have to get it right.
Yeah, for sure. And Phillip, I know, Clive, you're not from a banking background, but Phillip is. To mention Barclays, you've had a stellar career in Barclays, and now you work for yourself, still in the world of finance. So perhaps you could tell the audience a bit about yourself.
Thank you very much, Rob. Yeah, so Rob and I have known each other some years. I remember seeing him at presentations in the past. Excellent presenter, I must say. Yeah, I come from banking history at Barclays, joined at 16 years old and worked my whole career there, 40 odd years of it. Did a variety of roles there, a lot on the lending side. So yeah, a lot in finance. Latterly, in the last 10 years, I was a relationship director looking after professional services firms at Barclays, which were accountants, surveyors, architects and solicitors. So having left the bank a few years ago, I now have a variety of roles as an independent introducer, really. I've been working with Clive for quite a few years now as an introducer to him for invoice financing, which has been a productive and successful arrangement. Clive and I have also run an event in London called Money Meet Up Together, which obviously came to a halt when COVID came along, unfortunately. So, and apart from that, I do have hats in the legal sector, and I had a lot of law firm clients when I was at Barclays. So I still specialise in mergers and acquisitions of law firms. I have an arrangement with a company called Ampersand Legal Limited as an introducer again. And we're very busy at the moment. The market in the legal sector is very busy on the merger and acquisition side. And between us, Ampersand and I have completed 3 deals in the last 8 weeks. So thank you very much.
Brilliant. Yeah, thank you, Phillip. And I will confess my sins to the audience. Some of you will know I confess my sins. I used to be a bank manager back in the day when banking was banking. I think that was pre-compliance. When as a bank manager, you could charge whatever bank fees you liked every quarter, depending on how high maintenance your particular customer was. Those were the halcyon days. But
Right.
yeah, so you've got 3 finance guys coming from different angles, but with this recording, really we want to cover a number of topics. And the one I want to start with, Clive, is it's a hot topic, is the business recovery loan.
Yeah,
and I saw that you posted something recently on your LinkedIn with a picture of the Titanic. So it's business recovery loans are launched like the Titanic. I didn't see a question mark. I might have missed it. So was it a statement or a question?
It was a statement. I think all the lenders would say the same as well. It was launched very badly. It's settled down now. There's a lot of confused signals from the British Business Bank to the lenders, and I don't blame the lenders for this at all. They were very, I mean, it was unanimous amongst them that it was a bit of a shambles. But it's there now, and it works, and they are lending against business recovery loan. It's very much on the same basis as C-bills with certain differences. It doesn't have the free fees and interest for a year. It's probably more geared and more adaptable to MBIs, buying businesses, and it might be just a little bit more flexible in some aspects. It doesn't have to be quite so COVID related, which is possibly not a bad thing. Sorry.
Yeah, I was going to say, so there'll be some people in the audience that won't be au fait for whatever reason about business recovery loan. So in a nutshell, what is it? You know, what are the parameters? What's it designed to do?
Yeah, it's straightforward lending. It's based on a quarter of your turnover. That's the key point, right? 25% of your turnover. So if you turn over 1 million, you can borrow 250,000 over a period of time. Generally, that's flexible as well. It's a straightforward loan, repayable loan. The key thing is the cost and the interest rates. If you get it from your main bank or one of the big four banks, it will have to be your main bank because they won't accept. If you're with Barclays, they won't accept you going to Lloyd's to get the loan, and Lloyd's won't entertain it either. It could be a sluggish process, but the rates will be very competitive. I can't say exactly what they'll be, but you know, you might be talking 3, 4, 5% APR. Following that, from other lenders, if you take one of their products, such as invoice finance or trade finance or equipment finance, and get the business recovery loan alongside it, you'll pay slightly more, probably 7, 6, 7, 8%. And if you get a totally independent business recovery loan from BRCS or one or two others like that, the rates will be higher, and they can charge up to 15% APR. So that has to be considered very carefully. Wow. That doesn't mean it's cheap.
No, I mean, that makes a huge difference on repayments, of course, because I mean, you've got a range there you've just mentioned from 3%,
yeah,
5-fold difference.
I know, and people are not aware of that. And they were. That was the same under C-bills, but not many lenders under C-bills went as high as, well, it's 14.99% actually, but, but went as high as that. But one or two did, and it got a lot of bad publicity. Now it's under the radar a bit more because it's not quite so COVID related. But yeah.
Maximum repayment period?
I'll have to check on that. It's variable from lender to lender.
Okay, all right. Yeah, and obviously it's the traditional canons of lending. It'll be affordability.
That's right. Yes, I mean, you can't guarantee it. Just because it's 25% of turnover doesn't mean you're going to get it. The whole granting of C-bills to clients was absolutely baffling. You know, I had ones that were turned down by the independents, and the big banks supported them. You know, yeah, it was very, very haphazard, and I've seen some turned down that made no sense at all. And others,
yeah, I mean, the reverse I've seen as well, which is people getting it and not spending it on the designated purposes. A Ferrari.
That's a big story.
I won't say who it was.
Yeah, yeah. There's a bit of that. Well, there's quite a lot of that. That was more the case of the bounce back loan.
He said it was a rapid response vehicle.
Yeah.
To get to customers.
Yes. Yes.
Yeah. Okay. So it's had its teething problems, but from your experience, Clive, and perhaps I can bring Philip in, it's working well, is it?
I think so. It's very early days.
Right.
I haven't completed one yet. I'm due to complete one fairly shortly with another product. But as I understand it, I mean, really, we're only talking about a couple of weeks. It was launched at the beginning of April. It's only really been running a couple of weeks properly.
And how about you?
The end of December as well. Sorry, I got.
Right. Okay. That's important to know. Yeah. And Philip, are you getting in your role? Are you getting more inquiries coming through from your network?
I am getting more inquiries about lending generally. I tend to focus on the invoice financing with Clive, so I don't have expert knowledge about the other lending products. You have to keep up to date with these things, and I'm 7 years out of banking now, so I tend to rely on the people that I do know. I have relationships with some people at most of the key banks, and tend to liaise with them. Still have some colleagues at Barclays where I used to work, and liaise closely with them as necessary, really.
Yeah, I used to work for NatWest, so we had Lombard North Central as it was then.
Yeah.
But there was always, back in the day, there was always a bit of a stigma attached to invoice financing and credit factoring, its sister.
Yeah.
Has that moved and changed in more recent times?
Very much so. There's a stigma when I first came into it 10 years ago. It's now the main form of asset finance and probably the most flexible and cheapest. The stigma was rather attached to the fees that are charged and the behaviour of the lenders once they had the contracts out there and signed. And it was disgraceful. I mean, they were working too closely with insolvency practitioners.
Yeah.
And there's some dreadful behaviour. And
Yes.
that was happening when I first came into it. There were one or two lenders at the time I wouldn't go near. I wouldn't bring my client to my clients because I didn't trust them. They brought in the code of conduct a few years ago now, and that sharpened things up a bit. Not totally, but it's a lot better than it was. Now, the fintechs are coming to the market as well, so there's a lot more competition. There's over 50 lenders in the market.
Is there?
And if you think about it, really, I mean, the stigma is quite old-fashioned. I mean, a lot of it is based around factoring, which was we will do your credit control for you. Not something I totally believe in. It works sometimes, but I tend to believe, as an ex-credit manager, I know that clients often do their credit control, nearly always do their credit control better than a third party can, unless they're a really specialist third party working very closely with you.
Yeah.
The other side of it as well is that the fintechs coming in have opened up the market a lot more and given a lot more flexibility to products. They're far more flexible products than they were 10, 20 years ago. It was very, very rigid at the time. There wasn't much competition. Now it's fantastic, the range that's available.
Right. Well, if you've got 50 or so in the marketplace, that presumably is quite a minefield for the business owner. So perhaps going to someone like your good self is a good start.
Yeah, I mean, there's so many factors to take into consideration. Excuse the phrase factors, but you know, with 50, if you're just going to go to one, you've got a 2% chance, 1 in 50 chance of it being the right one, effectively. Probably less than that because they know that you're the only game in. They'll know that they're the only game in town, and they can charge what they want. I've seen quotes out there to clients from lenders, the more ruthless ones, which have been astronomical, and the lenders have been telling them all the stories in the world, you know, to convince them that's the only option they have.
Yeah, I mean, there's one thing I've seen when I've worked with businesses on turnaround situations. One of the things I look for is how their debt's structured, if there's debt in the business.
Yeah.
And there's usually quite a bit of wriggle room in terms of their existing invoice financing arrangements.
Absolutely.
Usually historic. They tend to go with their bankers.
Yeah, they do.
And they don't look around.
I could tell you, I could spend an hour telling you stories, but even yesterday I had a lead from one client who was paying over £10,000 a year on their full invoice financing, which doesn't sound a lot, but they only turned over about £400,000 a year. And that was to the main bank, right?
Good gracious.
I'm looking to halve that number, you know, and I expect to halve it, you know, and even that's at a time when the market is relatively expensive compared to how it has been because of the COVID, but you know, only marginally. But a lot of people are wrapped into very, very poor agreements. Yeah.
Yeah. So, Philip, when is a good time for a business owner who hasn't got any form of facility like that, but cash flow is tightening up for whatever reason? What are the telltale signs from your experience for a business owner, perhaps, that invoice financing is now for them?
So just going back to my days in Barclays, and we used to, you know, look at invoice financing, and it was construed as sort of lender of last resort, like we were saying earlier, and that sort of stigma was attached for a long time. But a lot of that has evaporated now and moved on. I remember the days when we did sort of debenture lending in Barclays, and then that was challenged by the courts because they said could we recover that amount if the company goes down? So I think, then we tightened up and pushed more lending perhaps towards invoice financing, which made it more effective. But yeah, I think, it's looking at the types of business that attracts to it. I remember at Barclays when we used to do what we call balance sheet lending. You'll remember this, Rob, when you look at the gearing ratio and you did your analysis, and gearing of 1-to-1 was the norm, where you perhaps would lend by way of overdraft or loan up to what the customer's got invested in the business himself, like the skin in the game, which they used to call it. I don't like that expression much, but you know what I mean. And I think that's that for an over trading business, where more businesses fail because they run out of cash than if they haven't making profit. And for an over trading business, it can work quite effectively, invoice financing, because the business grows with the debt, if you like, and it's a much more flexible product than most other banking products I've found. And those clients that need that flexibility, especially maybe recruitment, temporary recruitment particularly, that they would be really attracted to this type of lending.
I'm glad you mentioned that, actually, because it just resonated. Something you just said there, Philip, with my first day in banking back in 1982, where I was told by my new manager, my bank manager, apart from telling me that being in banking was a 40-year career and you had to tread on the heads of other people to climb the slippery slope, the slippery pole, the greasy pole of corporate life. I disregarded that advice. But one thing he did say was you can lose money, you can make a loss a number of times, but you can only run out of cash once. And of course, that's so true, isn't it? And
good, yeah.
And often, and I find this a lot with the smaller SMEs, that they confuse profit with cash.
Yeah.
And and they're not the same at all, obviously, are they? So I just something you said there, Philip, about the running out of cash. So it is a well accepted vehicle, even though there's a variety of products there, to fund growth. And you mentioned, Clive, a few minutes ago about business recovery loan being used potentially for acquisition. So and clearly that's in my space these days in terms of working with sellers of businesses, but also buyers. Management buy-ins, so funding an external investor to buy in either a stake or presumably 100% acquisitions as well.
Yeah, 100% is more common, actually. I mean, and invoice financing is what is the main vehicle for that. I just completed one yesterday, actually.
Right.
And the invoice financiers like it. They like doing MBIs. There's a lot of factors involved. I mean, one thing I will emphasise is don't go in. We look at what the client requires, right across the board, right? We don't go in saying, oh, you need invoice financing, that's your only solution.
Yeah.
I've had occasions where I turned around and said, that's not the right solution for you. And sometimes I say to them, you don't want a contract, right? You don't want a contract here. You don't want to be tied into something, monthly fees, however minimum they are for a year. You might only want this for 3 months. You might pay a bit more for a single invoice. So you might be better off just trying to get your overdraft or raising the money on your equipment or something like that. You've got to look at all options or have a pattern of options, and the business recovery loan comes into that now.
I was going to say, so you could help from two angles. One is you could help with the funding of an acquisition through your funding contacts. And then, I mean, often a quick win is the restructuring. If there's debt in the business, the restructuring of debt that makes a big difference to the company's cash flow. So you can help. That's double bubble win, really, isn't it, for the client?
Yeah.
And for you.
Yeah, of course. Yeah. And it's ignited the MBI market because without the business recovery loans, there's often not the scope to raise enough on the assets to make the initial consideration.
Yeah, I mean, it's a hot topic in my world of mergers and acquisitions because there has been in recent years this growing phenomenon of no money down, buy a business with no money down.
Yeah.
And it is a thing. It's not a thing that my clients who are looking for a premium price all on day one would ever entertain, but there is a market there. And often what they're tending to rely on, of course, is a buyer expecting the seller to wait for their money. So often called vendor financing. So the buyer of the business is sorry, the seller of the business is paid out of future profits of the business that they currently own now.
It's very,
Yeah.
very good. Sorry, I must let Phil
Go on.
speak. But just to very briefly come in there, not many people know this, but in one or two lenders, we have come to a scheme whereby the deferred consideration will be guaranteed by the lender out of invoice
Oh,
financing.
really?
Yeah, it's not common, and some lenders are blanched a bit when I've said that, but I know lenders will do it, and that can get it over the line. So totally understandable that a seller is nervous about selling to somebody who's just going to sit in their hands when, you know, another £1 million during a year's time, you know. And I'm talking about one today about that, but you know, it can be built into the agreement. It does need a few legals, but it can work. Yeah,
I never knew that, and I bet a lot of my audience didn't either. Yeah, I mean, it's a difficult one because I've heard this conversation between buyer and potential buyer and seller. The buyer says, "Well, you know, I'll pay. Basically, I'll pay you on the drip," and then of course the seller tends to rear up and say, "Well, you know, there's risk," and then the buyer says, "Risk? What risk? You said to me it was a brilliant business and the future was orange a moment ago. Do you not believe in your forecasts?" says the buyer.
I know.
So I think that's quite a useful way of bridging the gap to mitigate some of the risk. That's a really useful tip, Clive.
Yes, I hope I haven't overpromised on it, but it has been aired by a couple of lenders to me as a possibility. We did have legals drawn up on one, which about a year ago. Yeah.
And I mean, in terms of, I know people like top tips, so we'll look at perhaps 3 top tips as to how to secure funding, whatever shape or form that might be, from your experiences. And then the 3 pitfalls. What do you commonly see people dropping into as a pitfall? So we'll start with the positive, which is sort of 3 golden tips, golden rules that really help people get the funding that they're looking for. So perhaps we'll start with Clive first, then Philip.
Okay. I think the first thing to do is to take your time and explore the full market. Unlike in some areas of finance, like mortgages and equipment finance, there's a lot of variation in invoice finance. It's not just the price, it's the facility and what they'll fund going forward. It's a very complicated form of financing, actually, with many component parts. It's ongoing and it develops over time as well. So you've got to take your time and find the best possible solution. Don't just dive in. Very competitive market as well, which works in your favour. So that's the first.
So you can play one off against the other.
Oh, I do, yeah.
I'm sure you do.
I mean, you do it in a subtle way,
Of course.
but they don't like it, but they have to live with it. You know, that's not my problem; it's their problem. And it isn't a race to the bottom in terms of fees. The second tip is that invoice financing needs a lot of service. You need someone at the other end of the phone. You know, when you get a mortgage out, you sign it, you get it, and you just pay it. You know, you don't have to ring up someone in 6 months' time saying about my mortgage. You know, invoice financing, you've got a new client coming on board. It might be in France. You want to know, can it be funded? Can it do this? Can it do that? Will it take up a certain amount of the ledger? Is the contract okay for you to fund? So many things to consider. So you need a lender and a broker to support you going forward as well, because it's in the broker's interest to look after you going forward. Who will be responsive and will deal with those questions quickly. And the service from one lender to another varies an awful lot. I say the independents do have the advantage here, but not all of them. But so that's very important. Think of it as a very ongoing relationship. So that's the second tip. Yeah.
Brilliant. And Philip? You got one to add to it?
Yeah, I think for me, you know, having an expert like Clive to examine and explore the market for you is crucial, really. You know, it's so difficult to analyse yourself the terms and conditions, and some of these agreements have severe penalties in them. Clive's very, very good at doing that, and very good at acting the client, representing the client, I would say. He puts the client at the heart of everything he does. Rather than the lender, and that's really, really important and key. So I think that's, and also I think my other tip was probably don't just look at the interest rate that's being charged. Let's look at the overall costs, because some of the lenders can bring in extra costs for extra services and conditions for late submission of accounts, or a variety of things really. So just check out the whole package.
That's the thing, isn't it? It's the things that perhaps are tucked away in font 3 on page 19.
Yes, yeah, very
And
true.
also tend to be put in jargon.
Yes.
So the average person doesn't really understand what the implications. So I'd agree with you, Philip. I mean, like anything really in professional services, get an expert. It's going to cost, but the cost of doing it yourself will far outweigh if it goes belly up. Far outweigh. Yeah. Okay. Pitfalls. I mean, I'm going to feed you one pitfall that I regularly come across, and that's personal guarantees. I know we talked off air about this. PGs, affectionately referred to. There's this myth, or urban myth, or myth that you have to sign a PG. True or false, Clive and Philip?
Absolutely false. I mean, I dislike PGs, but occasionally they will be necessary. They'll be limited to an amount. They're not full PGs. One myth is that they will have a hold over your property. They don't. That has to be separately. Right. They can't. You don't sign a PG. It has to be backed by the property in a separate type of PG. It has to be made very clear to the borrower as well. There's a fair bit of I mean, with the banks and PGs, the court, if they end up in court, the court tends to veer towards the borrower. And the banks have to be very careful, because I know of one invoice financer that got a client to sign the PG, and they took him to court trying to claim on the PG, and the judge asked, where was this PG signed, right? And they said, well, we met him in the pub and we signed it there. And the judge said that was an inappropriate location and ruled it straight out, and saved the client £400,000.
Good gracious. I should think, with what you've just said there, Clive, I reckon there's quite a few high street lenders out there getting worried.
They are.
Interesting. Yeah, interesting.
They rarely impose PGs. They use it. What they tend to say is that we want you to sign the PG so to show your commitment to the business. Well, I've had some very stiff answers from clients back to lenders saying, what do you mean you're questioning my commitment to the business? And perhaps not in quite such polite terms as well. I had one meeting the construction, and he really nearly threw him through the window when he asked that. In all seriousness, I mean, it's a negotiating point. PGs aren't always necessary. Lenders are a little bit less demanding of them than they were, quite a bit less actually, much less than they were 10 years ago. And I know which lenders will be relaxed about them and which ones won't. There's one or two lenders that make a point of not asking for them at all, because they take the view we shouldn't be lending unless if we have to ask for PG.
Interesting. I've always taken the view that legally you set up a limited company to separate you as a person from the incorporated business you've just set up. So, signing a PG muddies the waters.
Oh, very much so. Yeah, very much so. I mean, and you get this revolving argument, and they say, well, the other one is that we want you to sign a PG to protect against fraud, to which the client feels a bit insulted and saying, why are you accusing me of fraud already? Which is, but there's a quick answer to that, which is that they sign a fraud warranty, right? They sign a fraud warranty, and that's it. And the banks try to push people into PG. Some of them do, or a lot of them will do, lenders. But if you've got someone on your side questioning it all the time, and it does become a bit of a circle, they say, they say, all these arguments for the PG, but you can take them apart gradually. But in some cases, I totally understand them from the lender's point of view.
You're almost, Clive, and it's not a disparaging comment, you're almost like the person that sets up to protect the common man that gets a parking fine.
you have to. Yeah,
Yeah,
a little bit more interesting
yeah,
than parking fine, but yeah, you have
you're
to
looking after the little guy compared to a big corporate.
yeah, big corporates. Yeah, I mean, some of my
Yeah.
clients be quite big. I mean, as well, but and they demand it. You
Interesting.
know, the one I recently did was a 30 million turnover manufacturer in aerospace in
Right.
Lancashire, and you know, you realise when you get to that stage, you're dealing with people pretty high end and are very, very, very good at this company.
Yeah,
very smart,
sophisticated.
and they're asking the questions that should be asked. You know,
Yeah.
we got a
Yeah.
great deal over the line with a very, very good lender, but it took 7 months. 7 months of negotiations. So, you know, it's not always a quick process, but
No.
that illustrates how complicated invoice financing can be, but it's
Yeah.
rewarding in the longer term as well.
I guess what the lenders are relying on is the customers' desire to get the funding that they so desperately are looking for. So prepared to not challenge, not negotiate, just
Yeah,
to get the money.
from the borrower's point of view, they shouldn't leave it to the point that they're desperate. They should be well
Mm,
prepared for this. You don't have to sign anything, but have something in mind. I've
right.
got one or two clients, I've got probably 3 at the moment who are just ready to go, but they're not signing yet because they don't actually need it at this point in time, you know?
Okay.
We're, you know, so don't put yourself in a position of being desperate. Don't keep putting it off because if you need it next week, you're going to be just,
Yeah,
you're going to
you are.
pay, you're going to pay, you know? If you want one in a hurry, my God, you know, thanks, you know?
Yeah. It's the golden rules of negotiating, isn't it? Time. It's interesting how one party will cave in
Exactly.
with the pressure of time. Yeah.
Yeah.
Look at Brexit, but we won't get into Brexit.
Right. Yeah.
Another pitfall from either of you guys that you've come across that people regularly fall into?
I think one pitfall is just assuming up front that perhaps invoice financing is not for you, and where people do get it wrong sometimes because there are the flexibility of invoice financing has grown, like Clive has said, in recent years. Over 50 providers now, and a lot of businesses and their accountants even assume that it's not available to this particular types of business. I remember one business that I introduced to Clive, which was in a Welsh business and in agriculture. And we, you know, they've been around for over 100 years. They've never used this type of finance. They had an overdraft and the loan from the bank. And Clive managed to find them a suitable invoice financing facility, and it's still running today and successfully. And it's a real win-win for them because it's given them a solution to their long-term needs, which they wouldn't have thought about otherwise. So I think, yeah, just talk to Clive or an expert like that up front, and you never know. I think it can be a pitfall just to assume that you can't get that type of finance when in fact it is available to you.
I think that's very helpful, actually. Very helpful.
Yeah.
And one final tip from each of you: if someone's looking to embark on growing their business and they're looking for external funding, one golden tip from your respective experiences.
Well, I would definitely come to a broker that knows the market. I'm bound to say that. I mean,
I'll set them up from midfield.
Yeah,
You put them in the back of the net. Yeah.
I think
Yeah, it's true though.
Without blowing our own trumpet, you've got to find a specialist. Now, there are a number of people out there who say they do invoice financing. I've met them at networking events, and they have a card and they do every type of financing under the sun. They're an expert in every single market. Mortgages, everything, personal loans, a lot. You can't be. You can't be. It's a full-time job keeping up with the asset. I call it asset finance. It's really asset finance we do.
Yes.
And it's a full-time job keeping on top of that market, meeting lenders all the time, talking to them all the time. And we have good relationships, although we don't work for them, but their products change all the time. There are new players in the market all the time. It's fascinating. It's a wonderful world to be in. It's by far the most interesting form of lending. But Philip brings up one very brief point, very briefly. People do have a slight prejudice against invoice financing. I have a client, been to a few times, and he wants financing, and he keeps suggesting every form of finance other than invoice finance because he keeps saying, well, can we have trade finance? Well, it costs you 3 times as much. Yes, it'll be far more complicated. I said, your solution is invoice financing. Oh, I don't want to use that. You know, and it's like, so people have really got to get over that a little bit. And the very final tip is they're lending against debtors. The detail is very important. Don't assume that your ledger of £100,000 is going to get 90% against it. You need that ledger analysed. I will analyse it. I'm a credit manager by trade, and I can analyse the contracts and the debtors and their credit worthiness as well. And I'll argue the toss with the lenders about the credit worthiness. Sometimes one lender will say this client is not credit worthy, and another one will say it is. You know, that is a very important component part. Sign an agreement, and then they're turning around in your biggest client and saying, "Oh, we won't fund that."
Yeah. I mean, it goes back to the old adage, isn't it? All that glistens is not gold. And yeah, you can't assume that what you're showing as your debtor book is going to be used by a third party.
Absolutely right. That is very, very important, actually. A lot of people just assume it, and they really do get stung.
I wonder, just as an adjunct, how many people check when they take on a new customer or client, do a credit check?
Well, that was my role.
The salesman won't, of course, because he wants the order. I wonder.
It's as a credit manager, I've checked thousands of clients in my role as a credit manager in a lot of industries. It's not just checking them; it's how you check them. If you go to a cheap agency, and I could name names, and you just pull off the rating and just rely on that, it can be very short-sighted, and you could be turning away good business.
Right.
Some of the better agencies, I'll name Dun & Bradstreet, will give you better ratings and more realistic ratings because they're looked at more individually. So credit management, credit checking is very, very sophisticated, but it's an opinion. And a lot of people get that very wrong, you know? And that would be lenders as well, you know? They won't fully understand clients.
I've got a way around it, gents. My clients' customers pay up front. I don't need a credit manager. The money's in the account. What I need is the customer service manager to make sure what's been promised is delivered.
My clients that supply to Tesco's and Sainsbury's and Marks and Spencer's have a little bit of difficulty with that one.
I'm sure they do. And Philip, I'm going to leave you with the final word, a golden tip or something that's helped you over the years with clients, customers, in terms of securing funding, much needed funding that they need.
I think, I suppose my final tip is, like Clive was saying, he's sort of trying to put the client at the heart of everything he does, and he's got the credit management background. I've got the banking background. I remember from my time at Barclays, it's always important, I think, to keep your finances up to date, to keep your records up to date as far as possible. Try and have management accounts so you know how profitable your business is. And also you've then got the information available. If you're looking at invoice financing, you've already got the availability of the information that Clive will need. He'll need to know what the spread of debtors is, for example. And if you haven't got your accounts up to date or your finances up to date, you're going to find it very difficult to move quickly. And often in these situations, you do need to move at speed. And Clive's very capable of doing that, but he needs the ammunition to do it.
Well, as an old banker, I definitely underline what you just said there. Robust financial reporting and make sure it's up to date. Otherwise, it's an uphill battle or uphill struggle for any business owner. Gentlemen, thank you. You've been very kind and generous with your time and also your advice. We're going to put your emails, addresses at the end of this video for people to get in touch. Can they get in touch with you by LinkedIn as well?
Yeah.
Brilliant. So do get in touch, do connect with these two guys on LinkedIn. And I know Clive, I've seen a number of his posts. He doesn't mind challenging the established way of thinking, which I love.
Okay, good.
More power to your elbow there.
Thanks
Clive.
very much.
Thank you for your time.
Pleasure. Thanks.
Thank you very much, Robert. It's great.
Yes. Thanks, Rob.
Cheers.